Welcome to today's Explainer. We're diving straight into CaixaBank, Spain's largest domestic lender and honestly one of Europe's absolute most compelling banking stories right now. I am super excited to walk you through this because what we're looking at today is a fascinating paradox. Over the next few minutes, we're going to completely break down CaixaBank's massive 2026 financial performance and then contrast that with a really surprising debate happening right now around their valuation. Basically, we've got record blowout earnings on one hand and a totally divided market on the other. It's a great story, so let's just dive right into it.
Quick housekeeping note before we get into the heavy data. This explainer is purely for informational and educational purposes, so it's not financial advice. And remember, past performance is never a reliable indicator of future returns. Always do your own research or chat with a professional before making any real investment decisions. All right, here's our roadmap for today. We're going to cover 1. The Spanish banking powerhouse. 2. Their record H1 2026 performance. 3. Strategic moves for tomorrow. 4. The great valuation debate, and we'll wrap up with 5. Key risks and headwinds.
Part 1. The Spanish banking powerhouse and CaixaBank's massive scale.
So headquartered right in Madrid, CaixaBank isn't just your standard run-of-the-mill bank. They are a deeply integrated financial group and, frankly, the financial heart of the Spanish economy. Just think about this number for a second. 20.9 million. That is the sheer number of customers they are serving across Spain and Portugal. They're managing this massive base through 4,500 branches, they've got roughly 47,000 employees, and are sitting on over 670 billion euros in assets. We're talking retail banking, corporate banking, cash management, the whole shebang. Seriously, if you're doing any kind of business in Iberia, you're almost certainly brushing up against CaixaBank.
Moving right along to Part 2, record-breaking H1 performance. Let's dig into that 2026 earnings report.
When CaixaBank finally opened its books on July 29th, the market was absolutely laser-focused on one specific figure, 3.203 billion euros. That was their net profit for just the first half of 2026. Now that's an 8.5% increase year over year from 2025, which is great, but more importantly, it beat analysts' expectations by about 5%. And look, in the institutional banking world, a beat of that magnitude commands immediate attention.
But the real surprise actually hit in the second quarter specifically. So the consensus forecast had Q2 net profit pegged at around 1.55 billion euros, while CaixaBank completely blew past that. They delivered 1.63 billion euros. That's a 10% jump year over year for the quarter, leaving all those market expectations totally in the rearview mirror.
Now you're probably wondering, where exactly did this billions of euros beat actually come from? Well, honestly, everywhere. It was completely broad-based. Net interest income, which, is basically the core measure of what they earn on loans minus what they pay out on deposits, that ticked up 2%. Service revenues surged an incredible 7.4%, easily crushing their own internal guidance, mostly driven by huge climbs in wealth management and protection insurance. Customer funds swelled to nearly 772 billion euros, and their performing loan book grew 8.2%. But here's the absolute cherry on top. While they were aggressively lending more money, their asset quality actually improved. Their non-performing loan ratio dropped to a super healthy 1.78%.
To kind of humanize this massive data dump, let's hear directly from the top. CEO Gonzalo Gortázar put it pretty bluntly, saying, "We achieved a profit of 3.2 billion euros and maintained our ROTE at 18%, demonstrating that we continue to deliver very successfully on our strategic plan. That 18% return on tangible equity, that is a massive metric for profitability, and it's backed by a rock-solid CET1 capital ratio of 12.5%. They aren't stopping there either. They're setting their sights even higher, targeting around a 20% ROTE in 2027.
So, what does this operational success actually mean for the folks holding the stock? A lot, as it turns out. It's translating directly into massive shareholder value. The bank approved a huge final 2025 dividend of 2.32 billion euros earlier in the year, which brought their total annual payout to staggering 3.5 billion euros. And looking ahead, the board is gearing up this October to lock in an interim 2026 dividend. They're expecting it to land somewhere between 961 million and 1.28 billion euros, paying out in November. For dividend-focused investors watching this space, this is a very direct, very tangible reward.
All right, Part 3, strategic moves for tomorrow, or how they're building beyond the balance sheet.
Look, raking in billions today is awesome, but how are they actually future-proofing the business? They definitely aren't just sitting back and resting on their balance sheet, they are aggressively expanding. Let's rapid fire through some of these 2026 initiatives, because the diversity here is just fascinating. First up, they grabbed an EU MiCA crypto license, making them Spain's 6th licensed bank to offer regulated crypto custody and trading. Huge move. Second, they flexed their corporate muscle, leading a 1.3 billion euro financing agreement for French telecom giant Orange. Third, they went global for funding, debuting a massive 1 billion Australian dollar kangaroo bond. Fourth, they aggressively backed domestic industry, pumping over 2.5 billion euros into the Spanish tourism sector in the first half of the year alone. Fifth, they pushed digital boundaries by rolling out a tap-to-pay mobile system through Bizum. And finally, they literally joined forces with heavyweights like ING and BNP Paribas to help develop a European euro-pegged stablecoin. They are actively forcing themselves onto the cutting edge of European finance.
Which brings us to part 4, the great valuation debate, and honestly, the real paradox of this market.
Okay, so you've just seen the stellar earnings and this aggressive, future-focused growth. So the stock must have skyrocketed after they announced all this, right? Well, here is the twist. Despite that solid 5% profit beat, shares actually fell about 6% right after the July 29 earnings announcement. No way, right? But context is everything here. You see, the stock had already rallied an unbelievable 99% in 2025 and added another 24% year-to-date in 2026. The market had basically priced in perfection. So when CaixaBank released these amazing numbers but decided to play it safe and not upgrade their full-year guidance, investors reacted. As Jeffrey pointed out, the lack of a guidance upgrade definitely came as a disappointment to a market that was just hungry for more.
But even with that 6% drop, institutional sentiment actually remains largely positive. It's just that a very clear divide has emerged on exactly how to value the bank moving forward. Jefferies is still highly bullish. They've got a buy rating and a 14 euro price target. Bank in turn maintains a buy as well. But then you have Rent4, who takes an overweight stance but caps their target a bit more conservatively at 11.86 euros. The market is fundamentally split right now on how much higher this stock can realistically go.
So this debate essentially boils down to two very distinct camps. On the bullish side, you have the Jefferies case. They see incredible momentum here, projecting a massive 15% compound earnings per share growth between 2025 and 2028. Just to put that into perspective, that is nearly double the European sector average. They see ROTE hitting 22% by 2028, which perfectly justifies their 14 euro target. But then there's the cautious camp, modeled by analysts like Simply Wall Street. They argue that after a massive 378% run over the last 5 years, all the good news is already baked into the price. Their model suggests a fair value closer to 11.93 euros, meaning they think the stock might actually be about 8.5% overvalued at current levels.
That takes us to our final section, Part 5, Key Risks and Headwinds. Let's look at how they're navigating these challenges.
Because let's be real, no investment exists in a vacuum. To figure out which side of the debate might be right, let's impartially break down exactly what CaixaBank is up against right now. First off, there is Spain's extraordinary banking tax. This is a very real headwind. CaixaBank paid 304 million euros in the first half of the year alone, which shaves roughly 10% off their annual EPS. They're challenging it in court, sure, but it is fully in effect for 2026. Second, we are definitely seeing some net interest margin pressure. Higher deposit costs are starting to squeeze margins, and while their overall NII grew, their Q2 NII actually came in just a tiny bit below consensus expectations. Third, regulatory scrutiny. It's a constant in this sector. Just this past January, the bank had to absorb a 30 million euro fine from Spain's money laundering watchdog over a legacy real estate deal. Fourth, as we just discussed, are those mounting valuation concerns after a 378% rally over 5 years. And finally, geopolitical and macro volatility continue to threaten market rates across the board. Though it's worth noting, CaixaBank remains quite optimistic, forecasting the Spanish economy to grow at 2.4% in 2026, which is double the Eurozone average.
Which leaves us with this final big looming question. We have seen the undeniably stellar earnings, their aggressive push into crypto, tourism, and digital payments, all backed by an 18% return on tangible equity. But on the flip side, we're looking at a stock that is up nearly 400% over 5 years, facing margin pressures and a pretty heavy banking tax. So, what do you think? Is CaixaBank one of Europe's absolute best structural, long-term growth stories, perfectly positioned to dominate the rest of the decade? Or is the cautious side right, that after such a monumental run, all the good news is simply already priced in? I highly encourage you to take these insights, dig into the sources yourself, and come to your own conclusion. Thanks so much for joining me on this explainer today, and keep learning.